On February 24, 2026, Michael Saylor posted 3 words on X: Bitcoin is on sale. 2 days earlier, his company Strategy filed an SEC document confirming the purchase of 592 Bitcoin at an average price of $67,286 per coin, spending approximately $39.8 million. That purchase was called the Orange Century because it was Strategy's 100th distinct Bitcoin acquisition since August 2020. 100 purchases through bull markets and bear markets, through crashes and rallies, through profit and through pain. At the time of that post, Bitcoin had just dropped below $63,000. The Crypto Fear and Greed Index had crashed to a reading of 5, meaning extreme fear at levels not seen since 2020. Strategy is currently sitting on roughly $12.4 billion in unrealized paper losses across its 717,722 Bitcoin. And they still bought more. To understand why Saylor is buying here, you first need to understand where Bitcoin actually is right now. On February 25th, 2026, Bitcoin is trading around $65,000. It peaked at approximately $126,000 in October 2025 and has since ground lower through $100,000, past $90,000, past $80,000, past $70,000, settling into a correction of roughly 48% from the all-time high. If you bought Bitcoin near the top, that is genuinely painful. But this kind of correction after a massive bull run is not unusual for Bitcoin. After the 2017 bull run, it crashed over 87%, and after the 2021 bull run, it crashed over 78%. A 48% drawdown is historically moderate by Bitcoin standards. The 2024 Bitcoin halving happened in April 2024. Historically, Bitcoin tends to peak roughly 17 to 18 months after a halving event. Bitcoin peaked in October 2025, exactly 17 months later. Textbook timing. Every previous post-halving cycle has followed the same pattern. A massive run, followed by a brutal correction, followed by a period of accumulation that sets up the next cycle. After the 2012 halving, Bitcoin ran from $12 to over $1,100 before crashing 87%. After the 2016 halving, it ran from $650 to nearly $20,000 before crashing 84%. After the 2020 halving, it ran from $8,700 to $69,000 before crashing 78%. Each time the crash felt like the end, and each time it was not. The question on everyone's mind now is whether we are near the bottom of this cycle or whether there is more pain ahead. That is exactly what Saylor is betting on. Saylor's thesis is built on several specific pillars, and none of them have anything to do with short-term price action. The first is the math of scarcity. There will only ever be 21 million Bitcoin, not one more, not one less, ever. As of today, approximately 19.99 million have already been mined, meaning fewer than 15,000 are left to enter circulation. After the 2024 halving, the rate at which new Bitcoin is created slowed dramatically. Saylor's core argument is that a fixed supply asset in a world of infinite money printing will, over a long enough time horizon, appreciate in value. Governments continue to expand their money supply, while Bitcoin supply is permanently capped. On February 20, he posted on X, "If it is not going to 0, it is going to 1,000,000. That is binary thinking, and it is intentional." The second pillar is institutional infrastructure. Spot Bitcoin ETFs were approved in the United States in January 2024, creating a massive on-ramp for everyday investors to gain exposure through their regular brokerage accounts. That was a structural shift in how institutional money could access Bitcoin. However, as of late February 2026, spot Bitcoin ETFs have recorded 5 consecutive weeks of outflows. Institutional money is currently leaving, not entering. Saylor's counter-argument is that these are short-term flows driven by hedge funds and tactical traders reacting to volatility. He sees the deeper trend as the custody solutions, regulatory clarity, and accounting frameworks that have been built over the past 2 years, infrastructure that did not exist during the previous cycle, and that he believes will eventually attract a wave of longer-term institutional capital that has not yet arrived. The third pillar is the corporate Treasury revolution. Strategy is no longer just a company that holds Bitcoin, it has become a template for how corporations can hold Bitcoin on their balance sheets. As of today, Strategy controls 717,722 Bitcoin, approximately 3.4% of the total 21 million supply cap. No other publicly traded company comes close. The second largest corporate holder, mining company Mara Holdings, holds just 53,250 Bitcoin. Multiple firms have started their own Bitcoin Treasury programs using Strategy's playbook as a model. Saylor's argument is that he is front-running a wave of corporate adoption that has not fully arrived yet. The fourth pillar is debt coverage. One of the biggest criticisms of Saylor is the question of what happens if Bitcoin crashes further. Strategy's CEO Phong Le addressed this directly in their earnings call, stating the company would not need to liquidate its Bitcoin holdings unless Bitcoin drops to around $8,000 and stays there for 5 years until 2032, when certain convertible note obligations mature. Bitcoin is currently at $65,000, still 8 times higher than the $8,000 liquidation threshold. The margin call fear is real, but the math suggests it remains a remote scenario. The fifth pillar is discipline at scale. 100 purchases over 6 years, through every kind of market condition, is the definition of dollar cost averaging applied at a corporate level that has never been attempted before. Most retail investors panic sell at the bottom and chase prices at the top. Saylor has done the opposite consistently for 6 years. He bought at $10,000, at $30,000, at $60,000, at $100,000, and now at $67,000. He bought through the FTX collapse, through multiple regulatory crackdowns, through every obituary the financial press has ever written for Bitcoin. Each week, Strategy sells shares in its stock, raises cash, and buys Bitcoin with the proceeds. It is a perpetual accumulation machine, and the 100th purchase is not a milestone of recklessness, but of systematic conviction that has no precedent in corporate finance history. Before talking about what comes next, it helps to understand why Bitcoin has been struggling so badly in February 2026. There are 3 main pressures hitting simultaneously. The first is tariff uncertainty. President Trump announced plans in late February to impose 15% tariffs on all goods entering the United States, along with targeted tariffs aimed at specific trading partners. Markets hate tariff uncertainty because it raises fears about inflation, slower growth, and trade wars. When investors get scared, they pull money out of risk assets, and crypto gets hit first. Bitcoin tumbled more than 5% in a single day, falling below $63,000 as analysts describe the move as tactical de-risking in response to tariff headlines. The second pressure is the broader tech sell-off. February 2026 has seen significant declines across major tech companies, driven by concerns about AI valuations. When the tech sector bleeds, crypto bleeds alongside it, because Bitcoin and growth assets tend to move together in risk-off environments. The third pressure is tax season. The IRS introduced a new cryptocurrency reporting form, 1099-DA, for the 2026 tax season. For the first time, many US-based crypto investors are receiving detailed tax reports from their exchanges. Some are being forced to sell crypto holdings to cover their tax liabilities from profitable 2025 trades before the April filing deadline. This selling pressure from tax compliance is real, and it is adding to downward price movement in the first quarter. 3 macro pressures at the same time explain why Bitcoin is where it is today. But here is where the picture shifts. Warren Buffett famously said, "To be greedy when others are fearful, and fearful when others are greedy." The Crypto Fear and Greed Index hit a reading of 5 on February 22. The scale goes from 0 to 100, and a reading of 5 means capitulation territory, the kind of reading that shows up only a handful of times per decade. The last time the index was this low was during the depths of 2020, when the world was shutting down. Historically, the best long-term buying opportunities in Bitcoin have almost always coincided with extreme fear readings. After the 2018 crash that took Bitcoin from nearly $20,000 to around $3,000, it went on to hit $69,000 in 2021. After the 2022 FTX crash that took it from $69,000 down to $15,000, it went on to hit $126,000 in October 2025. Bitcoin's current all-time high was set just 5 months ago. None of this guarantees that Bitcoin will recover from this correction, because past cycles do not guarantee future results. But the historical pattern is difficult to ignore. When Bitcoin was at $126,000, Saylor was still buying, but quietly with no dramatic posts. The day it dropped below $63,000, he posted, "Bitcoin is on sale." His timing is not random, but calibrated. He is the man who has spent more money buying Bitcoin than almost anyone else on Earth, and he is saying that right here, right now, this is an opportunity. That does not mean he is right, because the technical picture is concerning. Some respected analysts warn that if Bitcoin breaks below $60,000, the next major support zone could be in the mid to low $50,000 range, with more bearish models pointing toward $25,000 to $30,000 as the long-term bottom based on historical correction percentages. Strategy's leverage is real. A significant portion of their purchases have been funded through convertible debt, essentially borrowing money to buy Bitcoin. They reported a $12.4 billion loss in Q4 of 2025 under new fair value accounting rules for digital assets, and their stock has dropped over 50% from its highs. If financing conditions tighten and they cannot keep selling new shares or bonds, the buying machine could slow or stop entirely. ETF outflows are another warning signal. Spot Bitcoin ETFs were supposed to be the institutional demand engine that would provide a permanent floor of buying pressure. 5 consecutive weeks of outflows suggest that institutional money is leaving, not arriving. The very product that was supposed to legitimize Bitcoin in the eyes of traditional finance is currently seeing capital walk out the door. Until those flows reverse from outflows to strong inflows, assuming that institutional demand will catch a falling Bitcoin is premature. The macro headwinds from tariffs, trade war fears, AI sector disruptions, and global uncertainty do not disappear overnight. These forces could suppress Bitcoin for months, and anyone who tells you they know exactly when the bottom arrives is guessing. If Saylor's long-term vision plays out, the numbers become extraordinary. At $1 million per Bitcoin, Strategy's 717,722 coins would be worth over $717 billion, making it one of the most valuable companies on the planet. Saylor has suggested even more aggressive targets at conferences, arguing that as Bitcoin captures an increasingly large share of global wealth, from sovereign reserves to institutional treasuries to corporate balance sheets, the price per coin must reflect that accumulated value. Multiple countries are now debating Bitcoin as a strategic reserve asset. Crypto regulation in the United States is becoming clearer under the current administration. The U.S. Senate is actively working on crypto legislation. Layer 2 Bitcoin solutions are expanding the asset's utility beyond a simple store of value. The infrastructure for a much larger Bitcoin ecosystem is being built in real time. What Saylor understands that most people miss is the asymmetry of the bet. If Bitcoin goes to zero, he loses the investment, which is painful but survivable. If Bitcoin goes to $1 million and he does not own it, he misses the greatest wealth transfer in human history. The possibility of massive upside versus a defined downside is why he maintains conviction even through drawdowns of 40, 50, 60%. He treats volatility as a feature, not a bug. Every time Bitcoin drops, retail investors panic and sell, while Saylor buys, because he genuinely believes the dips are temporary noise. Tariff fears, tech crashes, tax selling, all of it is real, but all of it is temporary. The supply is fixed, and the demand over a long enough time period trends upward. A big dip simply means more Bitcoin for the same dollar. Strategy's leadership team talks to institutional investors, regulators, and government officials on a regular basis. They see capital flows and regulatory signals before they become headlines. When Saylor says Bitcoin is on sale, in the same week his company completes its 100th purchase, that confidence does not come from nowhere. It comes from a belief backed by institutional conversations, regulatory signals, and financial modeling that the fundamentals of Bitcoin are still intact and improving, even while the price says otherwise. History will ultimately judge whether Michael Saylor was right. But in February 2026, when the market is bleeding, when fear is at levels not seen in 6 years, when everyone is asking whether Bitcoin is dead again, the man who has spent more money on Bitcoin than almost anyone else on this planet is loading up his cart. He called himself a Bitcoin skeptic before August 2020. Then he bought $250 million worth in a single transaction and never looked back. 6 years and 100 purchases later, he is sitting on $12.4 billion in paper losses, and his response is to buy more. That is either conviction at a level most people cannot comprehend, or delusion at a scale that will become a cautionary tale for decades. The answer depends entirely on what Bitcoin does next, and nobody, not Saylor, not Wall Street, not any analyst on any screen, knows the answer to that question. Make of that what you will. If this video made you think, drop a like and leave a comment. Are you bullish or bearish on Bitcoin right now? Do you think Saylor is a genius playing the long game, or is he taking the biggest gamble in corporate history? I want to hear your honest opinion. Share this video with someone who holds crypto, because the data in this video is something every investor should see right now. And if you are not subscribed yet, hit that button and turn on notifications so you never miss the next one.